If you have $10,000, watch this before investing. Introduction. Why $10,000 is more powerful than you think. If you have $10,000 right now, let me tell you something most people will never hear. This amount of money can change the entire direction of your financial life, or it can quietly disappear without making any real difference. The outcome depends not on luck, not on intelligence, and not on secret information. It depends on how you think before you invest. In the United States, millions of people invest every year. Some build wealth steadily and peacefully. Others jump from one opportunity to another, chasing quick returns, following hype, and copying what they see online, only to end up disappointed, confused, or even broke. The shocking truth is that many of those people started with the same amount you have right now. This script is not about hot stocks, crypto hype, or get-rich-quick schemes. This is about what actually matters before you invest your first dollar. If you understand what I'm about to share, you won't just invest $10,000, you'll multiply its impact for the next 10, 20, or even 40 years. So before you open a trading app, before you listen to a YouTube influencer, and before you place your first bet on the market, watch this carefully. The biggest mistake most people make with $10,000 is treating it like a lottery ticket instead of a tool. People think, if I invest this correctly, I could double it fast. If I lose it, I'll just make it back. This is my one chance to get ahead. This mindset is dangerous. $10,000 is not small money, but it's also not infinite money. If you lose it, you don't just lose cash, you lose confidence, time, and momentum. Many investors never recover psychologically after their first big loss. Smart investors don't ask, how much can I make? They ask, how can I avoid losing? Because surviving the game is more important than winning early. Before investing, secure your foundation. Before investing even $1, you need to answer 3 uncomfortable questions. 1. Do you have an emergency fund? If your car breaks down tomorrow, or you lose your job next month, will you be forced to sell your investments at a bad time? If yes, you are not ready to invest. For most Americans, an emergency fund means 3 to 6 months of essential expenses in a high-yield savings account. Not invested, not locked, liquid, and safe. If you invest your emergency money and the market crashes, you lock in losses when you need cash the most. That's how people get stuck in debt. 2. Do you have high-interest debt? Credit card debt at 18 to 29% interest is not just debt, it's a guaranteed loss. If you invest while carrying high-interest debt, you are basically earning maybe 7 to 10% on investments while losing 20% plus on debt. That's not investing, that's financial self-sabotage. 3. Is your income stable? Investing works best when you don't need the money urgently. If your income is unpredictable and you might need that $10,000 soon, you should prioritize stability before growth. Understand this one rule. Risk comes first. Most beginners choose investments based on returns. Professionals choose investments based on risk. Here's what no one explains clearly. Greater than high returns are optional. Risk is mandatory. You cannot remove risk. You can only choose which risk you're willing to take. Market risk, inflation risk, liquidity risk, emotional risk, knowledge risk. If you don't understand the risk you're taking, you are gambling, not investing. Why timing the market fails almost everyone? Everyone wants to invest at the perfect time. Here's the reality. Even professional investors can't consistently time the market. Missing just a few good days can destroy long-term returns. Studies show that investors who try to jump in and out of the market almost always underperform those who stay invested. The market rewards patience, not prediction. Power of boring investing. Boring investing works. Index funds, ETFs, and long-term diversification have created more millionaires than any viral strategy ever will. Why? Low fees, broad exposure, less emotion. A boring investor who stays consistent often beats an exciting investor who panics. The real enemy is not the market, it's you. Fear and greed destroy more portfolios than crash ever could. People buy when prices are high because of excitement. People sell when prices are low because of fear. This behavior guarantees bad results. Smart investors create rules before emotions kick in. How $10,000 grows over time. The math nobody shows you. Let's look at reality. $10,000 invested at an average 8% annual return in 10 years, $21,600 in 20 years, $46,600 in 30 years, $100,600 in 40 years, to $117,000. No hype, no luck, just time and consistency. This is why time is more important than timing. Diversification is not optional. Putting all $10,000 into one stock, one crypto, or one idea is not courage, it's concentration risk. Diversification means different asset classes, different sectors, different strategies. You don't need the best investment. You need investments that survive different scenarios. Passive versus active investing. Choose wisely. Most people believe active investing is smarter. Reality: active investing requires time, skill, and discipline. Most active investors underperform the market. Passive investing is not lazy, it's strategic. The truth about financial influencers: many influencers make money from ads, sponsorships, courses, affiliates, not from investing. Always ask, are they paid to promote this? Do they benefit if you click? Are they showing long-term results or just screenshots? What successful investors do differently? They think long-term, control emotions, focus on process, not outcomes, ignore noise. Stay consistent during boring years. Wealth is built quietly. A simple, smart approach for $10,000 conceptual. Instead of asking what to invest in, ask, what matches my risk tolerance? What fits my time horizon? What allows me to sleep at night? The best investment is the one you can hold during bad times. Final reality check: if you have $10,000, you are already ahead of millions of people. But money only changes lives when paired with discipline. Fast money excites. Slow money lasts. Closing message. Before investing your $10,000, remember this: the goal is not to get rich this year. The goal is to never be broke again. If you master patience, control emotions, and respect risk, your $10,000 will not just grow, it will work for you for the rest of your life. If this script made you think differently about money, you're already winning.